Welcome back. Today we're kind of stepping into the big leagues, the high-stakes world of JPMorgan Chase, using, their 2023 annual report, really. It's fascinating how much it reveals.
Yeah.
Going beyond just, what they do, we'll look at how they approach challenges
Right.
and how their decisions, what they might mean for the future of the entire, financial landscape.
Absolutely.
So to start, the sheer size of JPMorgan Chase is just...
It's incredible, yeah.
They ended 2023 with $3.9 trillion in assets.
Wow.
Trillion, with a T.
Yeah.
Their stockholder equity alone, just that part, was $327.9 billion.
Yeah, you start to lose track of the zeros after a while.
It's mind-boggling. And it's not just one thing they do. They're in investment banking, commercial banking,
Right.
consumer and small business financial services. They handle asset management and even financial transaction processing.
Very diverse, yeah.
And their clients, well, it's everyone from individuals to massive companies to governments all over the world.
It's a truly global reach.
But here's what I find really interesting. JPMorgan Chase seems to get that in this day and age, talent, it's not just about degrees.
Yeah, I think they're recognizing that.
They're really actively looking for people with a variety of experiences, backgrounds,
Definitely.
They actually have a fellowship program specifically designed to help people re-enter the workforce
That's great.
after taking a career break.
Yeah.
So it's not just about, oh, do you have this degree from this university?
It's about the skills, yeah.
It's more like, what skills have you developed no matter where they came from?
It's a smart approach, especially in an industry as competitive as finance.
Oh, absolutely.
Think about it. Someone who's, let's say, taken time off to raise a family, they might have incredible project management skills, right? Or they've learned to be super resilient.
Yeah.
Or maybe they just come in with a totally fresh perspective on, how to solve problems.
Right. And when you're a company like JPMorgan Chase,
Yeah.
operating in so many different countries, industries, that kind of fresh thinking is gold.
Absolutely. It's a real competitive advantage.
But that scale, the bigness of it all,
Yeah.
it also means they're dealing with a ton of regulations.
Oh, for sure.
You've got the OCC, the FDIC, SEC, FINRA, CFPB, each with their own rules.
It's a complex web. Yeah.
It's a lot to juggle.
It really is. You're constantly balancing the need to deliver profits to shareholders with the need to comply with all these regulations.
Right. And some of those regulations might have goals that seem at odds with each other.
Absolutely. It's a real tightrope walk.
And then on top of that, they've got this extra layer of reputational risk.
Yeah, being a financial powerhouse comes with a lot of scrutiny.
They even mention in the report that they're, constantly under the microscope, watched by politicians, activists, everyone. And their decisions, especially in certain industries, it's interesting, they don't name specifics, but
Right.
it can directly affect their relationships with clients, even governments.
Yeah, every move they make is analyzed and can have a big impact.
It's high-stakes chess, for sure.
Absolutely. Let's say they decide to finance a company that, is involved in something controversial.
Oh, yeah.
Suddenly, some clients might get upset, their stock price could fluctuate. It might even become like a political talking point.
Yeah, it could spiral.
It just highlights how financial decisions, they're not made in a vacuum. They have real-world consequences.
Absolutely. And speaking of consequences, the report outlines, a whole bunch of potential financial risks, too.
Right.
There's extreme market events, counterparty defaults, cyber attacks, data breaches. The list goes on.
A lot to consider, yeah.
I noticed they're acknowledging how important it is to protect personal information, especially in a world where data is so valuable.
It's a huge responsibility.
It is. But what I found interesting is that they seem to have a very, a grounded view of risk.
You mean they're not pretending it doesn't exist?
Yeah. They're not saying, oh, we've got it all figured out. Look, we can't eliminate risk, but we can try to manage it.
That's a much more realistic approach, I think.
And that's where you see their focus on stress testing and, really solid risk management practices.
That makes sense.
The report even specifically says that even with all those practices, they could still face significant losses.
Sure, there are always unknowns.
They even give a very concrete example. Their subsidiary, JPMorgan Chase Bank, NA, they can't just distribute dividends however they want.
Interesting.
There are restrictions in place. Plus, they're subject to things like the supplementary leverage ratio, or SLR.
Right. That dictates how much capital they need to hold as a buffer.
Exactly. And then they also have this, it's called an IHC, an intermediate holding company.
Okay.
It adds another layer of complexity. The IHC can't pay dividends or give credit to a parent company if certain capital or liquidity thresholds are breached.
It's like a safeguard against excessive risk-taking.
Right. This whole multi-layered structure. And it makes you realize that the financial world, it's so interconnected now. It's not just about managing their own internal risks anymore.
It's about the risks that come from their entire network, their partners, their vendors, everyone they work with.
Exactly. Like, imagine if a third-party vendor they rely on gets hit with a cyber attack. That could disrupt everything, potentially expose sensitive data, impact their clients.
It highlights how crucial it is to have that broader perspective when managing risk in today's world.
And speaking of data, I mean, JPMorgan Chase knows they've got this huge responsibility when it comes to protecting personal information.
Oh, for sure. They're subject to tons of privacy laws, both in the U.S. and globally.
It's high stakes.
Yeah.
Any mistake could lead to, like, massive fines, lawsuits, damage their reputation.
Yeah, it's a lot to manage.
It is. And the way they talk about it in the report, it's interesting.
How so?
They really get that failing to protect data can totally erode customer trust.
Yeah, that's crucial in their business.
And that's something they can't afford to lose. So it emphasizes how important cybersecurity is, strong data governance, and really just a culture of data privacy across the whole organization.
It can't be just a box to check. It has to be part of their core values.
Absolutely. It's about building that trust.
For sure.
And, back in early 2024, there were some big leadership changes.
Oh, right.
They got new co-CEOs for the expanded commercial and investment bank.
Always makes you wonder what direction a company's going to take.
Yeah, like whenever you see leadership changes at that level, you think, okay, are priorities going to shift? Will they get more cautious about risk in some areas?
It'll be interesting to see how these new leaders shape the future of the firm.
It's like watching a really intense game of chess.
Yeah.
Each move sets up what's going to happen next.
Absolutely.
But before we get into their, specific financial performance and all that, there was one other thing that I thought was really thought-provoking in the report.
What's that?
The whole challenge of valuation.
Yeah, it's not as straightforward as it might seem.
Think about it. JPMorgan Chase's balance sheet. It's full of all these complex financial instruments. And a lot of them are incredibly difficult to value accurately.
That's true. Figuring out the fair value of, let's say, a complex derivative. It's not like measuring, the length of a table.
Who's that?
There's a lot of estimation involved, interpretation. You're relying on these models, and the models themselves are based on assumptions.
Right.
And even small errors in those models or in your judgment, they can have a big impact on their reported earnings.
Yeah, it's a reminder that even in, high finance, there's still a degree of uncertainty.
Absolutely. It's not a perfect science by any means.
Now let's get into the numbers. Let's look at their 2023 financial performance, starting with the return on equity, or ROE.
Okay, ROE. That's a good place to start.
Their corporate and investment bank, so the CIB, had an ROE of 13%.
13%, okay.
Commercial banking was a bit higher, at 20%.
20%, all right.
But their asset and wealth management, so AWM, they hit 31%.
Wow, that's impressive.
It's interesting, right? They're not relying on just one part of their business to be successful.
They're diversified.
That's smart.
It allows them to weather different economic storms, take advantage of opportunities in different markets.
Absolutely.
Yeah.
But that AWM performance really suggests they're doing something right with managing those client assets.
Right. Generating those strong returns. Now, let's zoom in a bit on some of the details of their revenue and expenses.
Okay.
Because there were a couple things that jumped out at me. For example, they had $4.2 billion in FDIC-related expenses.
$4.2 billion. Wow.
Yeah, and that makes me think that they were involved in some pretty big transactions, possibly even like the resolution of some institutions that were failing.
That makes sense given the FDIC's role.
Right. And they also had $280 million in credit adjustment losses.
Okay.
Which probably reflects adjustments they had to make to the value of some loans or other credit instruments. Yeah, that could be due to changes in market conditions or the creditworthiness of certain borrowers.
Right. And it just shows you how sometimes they seem like small details in a financial report, but they can tell you a lot about what a company is actually dealing with.
Absolutely. They're like little clues that help you piece together the bigger picture.
Now let's shift our focus to governance. JPMorgan Chase has this It's really a very complex structure with a board of directors and all these committees.
Right, they're responsible for oversight of all sorts of things.
Yeah, risk management, capital allocation, public responsibility, the whole gamut.
It's crucial for a company of their size and influence to have strong governance.
Absolutely. Because, it's not enough for them to just make money. They have to do it ethically, responsibly, sustainably.
I agree.
And these committees, like the Audit Committee, the Risk Policy Committee, the Compensation Committee, they're there to hold management accountable, make sure they're acting in the best interest of everyone involved.
It's a system of checks and balances.
And they're not just looking at financial performance. They even have a Public Responsibility Committee.
Oh, that's interesting.
Yeah. It highlights how they're becoming more aware of environmental, social, and governance factors, the whole ESG thing.
Right. It's a growing trend.
They're recognizing that their actions have a broader impact. It's not just about the bottom line.
Absolutely. It's about recognizing their impact on the world around them.
Absolutely. It's about making a positive impact. Now, let's get into how they make it all happen. Capital allocation.
Okay. The fuel for their operations.
It's how they decide where to put their money. And they have this whole detailed methodology for it.
It's a big decision for sure.
They take into account things like risk-weighted assets, stress test results, and the GSIB surcharge.
Ah, yes, the GSIB surcharge. That applies to them because they're considered a globally, systemically important bank.
Right. Basically, it means that if they failed, it could have a ripple effect throughout the whole financial system.
It's a huge responsibility.
It is. And it comes with these extra capital requirements. And on top of all that, they're also trying to figure out what the impact of the U.S. Basel III proposal might be.
Right.
It could significantly increase their capital requirements.
Okay.
Potentially leading to like a 30% increase in risk-weighted assets and a 25% increase in the amount of capital they need to have on hand.
Wow, that's significant.
The constantly changing landscape.
Yeah.
And they're having to adapt.
Definitely.
Speaking of adapting, let's talk about liquidity. JPMorgan Chase has a massive $1.4 trillion in available cash and securities.
That's a lot of liquidity.
It's like a giant financial cushion to make sure they can meet their obligations, even when things get tough.
Yeah, it shows their commitment to maintaining a strong financial foundation.
And it's not just their own cash reserves. They also have borrowing capacity from institutions like the Federal Home Loan Banks or FHLBs.
Okay.
And even the Federal Reserve is there as a backstop in times of crisis.
So they have a lot of options if they need additional funding.
It's like having a financial safety net, just in case.
Makes sense.
Now, let's dive into credit risk. This is the risk that borrowers won't be able to pay back their loans.
It's a fundamental risk for any lender.
And with over $2 trillion in credit exposure,
Wow,
spread across all sorts of industries and sectors, JPMorgan Chase, they've got a huge job in managing that risk.
It's a daunting task for sure. I mean, they're one of the largest lenders in the world.
Right.
And their lending decisions have a real impact on the global economy.
It's not just about their own bottom line. Their risk management practices affect the whole financial system.
Absolutely.
So how do they approach it? Well, they use a combination of different methods, starting with a very rigorous underwriting process.
Makes sense.
Before they lend money, they really scrutinize the borrower's financial health, their track record, their ability to actually pay back the loan.
They're doing their homework.
It's not just about, handing out money to anyone who asks.
No, it's a careful evaluation.
And they're also diversifying their loan portfolio, spreading the risk across different industries and sectors.
Smart move.
So if one part of the economy takes a hit, it doesn't take them down with it.
Exactly. Diversification is key.
And of course, they're using stress testing.
Right, to see how their portfolio would hold up under different economic conditions.
It's like they're running simulations, saying, okay, what if interest rates go way up? What if there's a recession?
It's a way to prepare for the unexpected.
Exactly. Now, let's take a closer look at their actual credit portfolio.
Okay, let's break it down.
Their annual report, it gives a nice breakdown of their exposure by industry, so we can see where they're focusing their lending.
Interesting.
As of December 31st, 2023, their real estate portfolio, it was heavily weighted toward multifamily loans.
Multifamily, okay.
Totaling $121,967 million. Then industrial loans came in at $20,272 million, and office loans were at $16,494 million.
Those are some big numbers.
It's clear they're seeing opportunities in commercial real estate.
Definitely.
But they're not just betting on one sector, right?
Right. They're also active in consumer and retail lending. Retail loans reached $36,376 million, and loans for business and consumer services totaled $35,214 million.
So they're supporting all sorts of businesses, from those small retailers to the big service providers.
It's a pretty diverse portfolio.
Now let's turn our attention to operational risk. It's a big one for any financial institution.
Especially one as large and complex as JPMorgan Chase, yeah.
We're talking about everything from, cyber attacks to data breaches to internal fraud to even natural disasters.
A lot can go wrong.
It's a lot to manage. And JPMorgan Chase has this sophisticated framework they use to try and tackle it all.
What's it called?
It's called the CCR Management Framework.
TCOR.
It stands for Compliance, Conduct, and Operational Risk.
Sounds pretty comprehensive.
It's designed to make sure that everything JPMorgan Chase does is done safely, ethically, and follows all the laws and regulations.
Right. So it's not just about preventing specific bad things from happening.
It's about creating a culture of risk awareness and accountability everywhere in the organization.
It's like building a risk-aware mindset.
Yeah. It's about embedding risk management into the DNA of the company. And a big part of this framework is the role of the control management organization and internal audit.
Ah, yes, those two groups are key players.
So let's talk about what they do. The control management organization, they're the first line of defense. They work with the different business units to figure out what the potential risks are.
Okay.
They design and implement controls to try and mitigate those risks.
So they're building the safeguards.
Right.
Yeah.
And then they monitor how effective those controls actually are.
Makes sense. So they're constantly evaluating and adjusting.
And then you've got internal audit. They come in and independently check everything.
Like an independent watchdog.
They report to both management and the board of directors. So they're making sure that the risk management practices are actually working as intended.
They're providing that objective assessment.
Yeah, they're not afraid to challenge the status quo and point out any weaknesses.
Important role.
And, of course, with all the technology that JPMorgan Chase uses, cybersecurity is a huge focus.
Oh, absolutely. That's got to be top of mind for them.
They've invested a lot in building a strong cybersecurity program.
Right. Gotta have a dedicated team of experts.
They're constantly battling these increasingly sophisticated threats, like ransomware attacks and data breaches.
The landscape is always changing.
It's an ongoing challenge. And the report specifically mentions the risks that come from their third-party relationships when it comes to cybersecurity.
That makes sense. Your security is only as good as the weakest link in the chain.
Exactly. If one of their vendors has a data breach, it could create a way for hackers to get into JPMorgan Chase's systems.
So they have to be really careful about who they partner with.
They have to make sure those vendors have strong cybersecurity practices and then keep monitoring them to make sure those standards are being met.
It's a big responsibility.
It is. Now let's shift gears a bit and talk about the ethical side of things.
Okay.
In an industry like finance,
Yeah.
which is super competitive,
Yeah.
and there's a lot of pressure to make money, how does JPMorgan Chase make sure that its employees are making ethical decisions?
That's a good question.
Yeah.
It's about more than just profits.
They actually have this very detailed code of conduct.
Okay.
It's like a guide for ethical behavior within the firm. It lays out their values, what they expect from employees in all aspects of their work.
It covers a lot of ground, I imagine.
It does. Everything from conflicts of interest and insider trading to bribery and corruption and even, the responsible use of social media.
Wow, they're not messing around.
It's not just about, technically following the law. It's about creating this whole culture of ethical decision-making.
Yeah, it's got to be embedded in the way they do business.
And they really try to reinforce this code of conduct.
How so?
Well, all new employees, when they join, they have to go through mandatory training. And then every year, all employees have to reaffirm that they're committed to upholding the principles.
So it's not just a one-time thing. They're constantly reminding people.
Yeah. And they also have ways for employees to report potential violations without being afraid of retaliation.
That's really important.
It creates that environment of transparency and accountability. If people see something that seems wrong, they can speak up. And hopefully those small problems don't turn into big ones.
Right. It's about catching things early.
And, we talked about this before, but the whole challenge of valuation, I keep coming back to it.
Yeah, it's fascinating.
Because it's just this inherent difficulty of accurately putting a value on all those complex financial instruments they hold.
It's not easy, that's for sure.
And they acknowledge that in their report, which I think is really refreshing.
It's a sign of honesty, yeah.
Like, They're not pretending it's a simple task.
Because it's not.
A lot of their assets, like those complex derivatives and structured securities, they don't have a price tag you can just look up.
You can't just go to a market and see what they're trading for.
Right. Their value depends on so many things. Interest rates, market volatility, even the creditworthiness of whoever they're dealing with.
It's a complex calculation.
So they have to use all these models, rely on expert judgment to come up with an estimated fair value.
Right. And those models are only as good as the assumptions they're based on.
And those assumptions can change really quickly.
Especially in today's volatile markets.
But there's always this element of uncertainty.
Yeah, you can't eliminate it entirely.
Now, let's look at how all of this translated into their actual financial performance in 2023.
Okay, let's see how they did.
The annual report is packed with data.
It always is.
We can see their profitability, their sources of revenue, all their expenses.
Lots to dig into.
One of the key metrics, as we've talked about, is return on equity, or ROE.
Right. It tells you how efficiently they're using their shareholders' money to generate profits.
And their different business segments had, varying ROEs, which makes sense.
The different parts of the business face different challenges and opportunities.
For instance, their corporate and investment bank, the CIB, they had an ROE of 13%.
13%.
While their commercial banking segment, they came in at 20%.
20%, all right.
It shows the benefit of having that diversified business model.
Yeah, they're not putting all their eggs in one basket.
They're not relying on just one part of their business to succeed.
That makes them more resilient.
And then you've got their asset wealth management, AWM.
Yeah, how do they do?
They hit a 31% ROE.
Wow, that's a stellar performance.
It's clear they're doing something right in that segment. Managing client assets, generating strong returns.
They're hitting it out of the park.
Now let's dive into a few specifics from their revenue and expenses.
Okay, what caught your eye?
A couple things. First, they reported $4.2 billion in FDIC-related expenses.
$4.2 billion. That's a lot.
It suggests to me that they were involved in some pretty major transactions. Maybe even like resolving some failing banks.
Could be. It definitely indicates a significant level of activity.
And then they also had $280 million in credit adjustment losses.
Okay.
Which probably means they had to adjust the value of some loans or other credit instruments they hold.
Could be due to a change in market conditions, a downturn in a certain industry, or maybe even a specific borrower running into trouble.
It highlights that even with their sophisticated risk management, they're not immune to losses.
No one is.
Now, let's shift gears and talk about governance.
Okay, governance. Important topic.
JPMorgan Chase has this really complex structure with a board of directors and a bunch of different committees.
Right. They're responsible for oversight, making sure things are running smoothly.
Exactly. They're overseeing everything from risk management to capital allocation to public responsibility.
It's a big job.
It is. And it's important because it's not enough for a company this big to just focus on profits.
Right.
They have to operate ethically, responsibly, and sustainably. And these committees, like the Audit Committee, the Risk Policy Committee, the Compensation Committee, they're there to keep management in check.
Make sure they're acting in the best interests of all stakeholders.
Shareholders, customers, employees, everyone.
That's a lot of people to answer to.
And what I find interesting is that they also have a Public Responsibility Committee.
Oh, really?
It shows that they're thinking about their impact on the world.
It's a sign of the times. More and more companies are focusing on environmental, social, and governance factors, the whole ESG thing.
Exactly. They're realizing that their actions have consequences beyond just their bottom line.
They're part of a larger ecosystem.
Now let's dive into capital allocation.
Okay, capital allocation. It's all about deciding where to put their money.
It's the fuel for their operations. And they've got this very detailed methodology for it.
It's a complex process, for sure.
They take into account all sorts of factors like risk-weighted assets, the results of their stress tests, and the GSIB surcharge.
Right, the GSIB surcharge. That applies to them because they're considered a globally systemically important bank.
It means their failure could potentially destabilize the whole financial system.
It's a huge responsibility.
So they have these extra capital requirements. And on top of that, they're also trying to figure out what the impact of the U.S. Basel III proposal might be.
It's a lot to keep track of.
It is. That proposal could significantly increase their capital requirements, potentially leading to like a 30% increase in risk-weighted assets and a 25% increase in the required capital.
Wow, that would be a major shift.
The regulatory landscape is constantly changing, and they have to be adaptable.
For sure.
Now let's talk about liquidity. This is all about making sure they have enough cash on hand to meet their obligations.
It's about being prepared for unexpected events.
And JPMorgan Chase is in a pretty strong position.
How so?
They have a whopping $1.4 trillion in available cash and securities.
That's a lot of liquidity.
It's like a giant financial cushion to help them weather market volatility and meet any unexpected demands for cash.
It's a sign of their financial strength.
And it's not just their own cash reserves. They also have borrowing capacity from institutions like the Federal Home Loan Banks or FHLBs.
Okay.
And they can even turn to the Federal Reserve in a crisis.
So they have multiple lines of defense.
Exactly. It's like having a financial safety net, just in case. Now, let's dive into credit risk. This is the risk that borrowers won't be able to repay their loans.
It's the fundamental risk in banking.
And with over $2 trillion in credit exposure across all sorts of industries and sectors, JPMorgan Chase has a huge job in managing that risk.
That's a massive portfolio.
It is. And they take a multifaceted approach, starting with a really rigorous underwriting process.
That makes sense. They need to be careful about who they lend to.
Before they give anyone money, they scrutinize their financial statements,
Uh-huh.
their credit history, their overall ability to repay,
You're doing their due diligence.
and they're also diversifying their loan portfolio, spreading the risk across different industries and sectors.
That's a good strategy.
And they're using stress testing to simulate different economic scenarios.
Right, to see how their portfolio would hold up under adverse conditions.
Their annual report breaks down their credit exposure by industry so we can see where they're focusing their lending
Interesting.
as of December 31st.
2023, their real estate portfolio was tilted heavily, actually, towards multifamily loans.
Multifamily, okay.
Yeah, totaling $121,967 million. Then you've got industrial loans at $20,272 million and office loans at $16,494 million.
Wow. Okay, so it seems like they're pretty into commercial real estate then.
Yeah, those numbers definitely suggest they see opportunity there. But they're not putting all their eggs in one basket, of course. Diversification is key, remember.
Right, of course. What other sectors are they lending to?
Well, consumer and retail lending is another big area for them. Retail loans hit $36,376 million, while loans for business and consumer services combined reached $35,214 million.
So they're supporting a wide range of businesses then, small retailers, big service providers, all kinds of stuff.
Exactly. It's a pretty broad portfolio. And they're also lending a good chunk of change to the food and beverage industry. Those loans totaled $33,186 million.
Food, beverage, interesting.
Yeah. And then consumer hard goods loans came in at $13,366 million.
Okay, so it seems like their lending activities really mirror, like, the overall economic trends. Now let's switch gears a little and talk about operational risk, because that's a big deal for any financial institution.
Absolutely. And especially for one as huge and complex as JPMorgan Chase.
Right. We're talking about everything from cyber attacks and data breaches, internal fraud, even things like natural disasters.
There's a lot that can potentially disrupt their operations.
A lot to manage. So JPMorgan Chase, they use this, it's a pretty sophisticated framework to try and tackle it.
What's it called?
The CCR Management Framework.
CCOR, what does that stand for?
It stands for Compliance, Conduct, and Operational Risk.
Okay, so it sounds like they're taking a very comprehensive approach.
Yeah, it's all about making sure everything they do is done safely, ethically, and in compliance with every single law and regulation that applies to them.
It's not just about preventing specific incidents. It's about building a culture of risk awareness throughout the organization.
Right. It's about making everyone in the company, from the CEO down to, the entry-level employees, make them all aware of the risks and their role in managing those risks.
It's about making risk management part of their everyday thinking.
Absolutely. And a big part of this framework, this CCOR framework, is the role of two key groups: the Control Management Organization and Internal Audit.
Ah, yes. Those are important functions in any large organization.
So let's talk about what they do. The Control Management Organization, you can think of them as the first line of defense.
Okay.
They work directly with the different business units to identify potential risks. Then they design and implement controls to try to mitigate those risks.
So they're the ones actually building the safeguards.
Right. And then they also monitor how effective those controls are, on an ongoing basis.
So it's a continuous process of evaluation and improvement.
Exactly. And then you've got internal audit. They come in and do these independent checks to make sure everything is working as intended.
They're like the quality control team for risk management.
And they report to both management and the board of directors. So they have a lot of independence.
That's important for objectivity.
They're not afraid to challenge the status quo and point out any weaknesses they find.
It's a crucial role.
Now, considering how much JPMorgan Chase relies on technology, cybersecurity has to be a huge focus within their operational risk management.
Absolutely. That's a major risk factor for any financial institution these days.
They've invested a lot in building up a strong cybersecurity program.
Got to have a dedicated team of experts, for sure.
Constantly battling those, increasingly sophisticated cyber threats we see all the time.
The hackers are always coming up with new tricks.
It's an ongoing battle. And one thing they highlight in the report is the risk that comes from those third-party relationships when it comes to cybersecurity.
That makes sense. It's all about the weakest link in the chain, right?
Exactly. If one of their vendors has weak security and suffers a data breach, it could create a way for attackers to get into JPMorgan Chase's systems.
So they can't just focus on their own security. They need to make sure their partners are up to par as well.
Exactly. They have to carefully vet all their vendors, make sure those vendors have robust security practices, and then monitor them constantly to make sure those standards are being maintained.
It's a big responsibility.
It is.
Yeah.
Now let's switch gears for a minute and talk about the ethical side of things.
Okay. Ethics. Always important, but especially in finance.
Right. It's such a competitive industry. There's a lot of pressure to make money. So how does JPMorgan Chase ensure that their employees are making ethical decisions?
It's about more than just maximizing profits. They need to build a culture of integrity.
Well, they have this very detailed code of conduct.
Okay.
It basically outlines all their values and expectations for how employees should behave.
It's like their ethical playbook.
Yeah. It covers everything from conflicts of interest and insider trading to bribery and corruption to even, the proper use of social media.
Wow, they're covering all the bases.
It's not just about technically following the law. It's about fostering a culture of ethical decision-making at every level of the organization.
It has to be embedded in their DNA.
And they take it seriously. All new employees have to go through mandatory training on this code of conduct.
Right. Got to set the tone from day one.
And then, every single year, all employees have to reaffirm that they're still committed to those principles.
So it's a constant reminder.
Yeah. And they also have systems in place for employees to report any potential violations without fear of retaliation.
That's crucial for creating a culture of transparency and accountability.
If people see something that doesn't seem right, they need to feel comfortable speaking up.
And know that their concerns will be taken seriously.
Exactly. Now, we talked earlier about the whole challenge of valuation.
Yeah, that's a tricky one.
And it really stuck with me because it's just such a fundamental aspect of financial reporting.
It is. You need to be able to accurately assess the value of your assets.
But when you're dealing with all these complex financial instruments, it's not always easy.
No, it's not, especially when you have things like complex derivatives and structured securities.
Those don't have a readily observable market price.
You can't just look them up on a stock exchange.
Exactly. Their value depends on so many factors. Interest rates, market volatility, even the creditworthiness of the counterparties involved.
It gets complicated quickly.
So JPMorgan Chase has to use all these sophisticated models and rely heavily on expert judgment to come up with an estimate of what those instruments are actually worth.
Right, and those models are based on assumptions, which can change quickly depending on market conditions.
Exactly. There's always an element of uncertainty.
It's the nature of the beast.
Now, let's shift gears and talk about JPMorgan Chase's overall financial performance in 2023. Their annual report gives us a pretty detailed picture of their profitability, their sources of revenue, and their expenses.
It's a treasure trove of information.
It is. And one of the key metrics for gauging their performance, as we've talked about, is return on equity, or ROE.
Right. It tells you how effectively they're using their shareholders' money to generate profits.
And their different business segments had varying ROEs in 2023, which reflects the different market dynamics they're dealing with.
Different businesses face different challenges and opportunities.
For instance, their corporate and investment bank, the CIB, they reported an ROE of 13%.
13%, okay.
While their commercial banking segment achieved a more robust 20%.
So a bit of a range there.
It highlights the benefit of having that diversified business model.
Yeah, it helps them weather the ups and downs of different markets.
But one segment really stands out in terms of performance. Their asset and wealth management segment, AWM, they hit a 31% ROE.
Wow, that's impressive.
Clearly, they're doing something right in that part of their business.
They're firing on all cylinders.
Now, let's zoom in on a couple of specific line items from their revenue and expenses, because I noticed a few things that I thought were pretty interesting.
Okay, what caught your eye?
Well, first of all, they reported $4.2 billion in FDIC-related expenses.
$4.2 billion. That's a significant amount.
It is, and it suggests to me that they were involved in some pretty major transactions, maybe even, the resolution of some failing institutions.
That would make sense, given the FDIC's role.
All right. And they also had $280 million in credit adjustment losses.
Okay. That's not insignificant either.
Which probably means they had to adjust the value of some of the loans they hold or other credit instruments on their books.
Could be due to a change in market conditions, a downturn in a particular industry, or even a specific borrower running into trouble.
It just highlights that even with their sophisticated risk management systems in place, they're not immune to losses. If you're interested in learning more about the world of business and finance, make sure to subscribe to our show. We're delivering priceless information, completely free, right here in your podcast feed. We'll see you next time.